We are going to discuss GAAP principles and assumptions. When we discuss GAAP, we mean generally accepted accounting principles. These are set by overseeing bodies when it comes to publicly traded companies. These are almost like rules that publicly traded companies need to follow to be in line with government expectations. So let's talk about the different principles and assumptions. The first principle is the cost principle. That means that we have to record our assets, anything we buy, at cost. The reason why we wouldn't record this at a sales price is because a sales price is variable. And if we're recording variable prices on our financial statements, it's not really accurately reflecting the operations of the business. So we as a publicly traded company are required to report at the cost of the asset. The revenue recognition principle asks us to state our revenues when they are earned. That doesn't necessarily mean when we receive cash. Cash, as you know, people might pay on credit. We don't get the cash immediately. We need to wait until they actually pay our business. We will record it as soon as they have made the contract, not when we actually receive cash. Okay, so that brings into account accrual-based accounting. We record revenue as it's earned, not necessarily when cash is received. Expense recognition principle, also known as the matching principle, requires that businesses record their expenses and match them with revenues. So we're not recording our expenses separately of the time period when we record revenues. We're recording them when we actually have revenues earned. So matching our expenses in the same period as revenues. If we didn't do that, we might be top heavy on revenues and lower on costs, which wouldn't accurately reflect how our business is operating, or vice versa. So we want to make sure that to present financial statements fairly, we match our expenses with our revenues. The next principle is our full disclosure principle. This means that we have to report on our financial statements everything that a user of information would be able to use to make an informed decision. Usually when we're talking about full disclosure, we mean what's being disclosed in the notes. So it may not necessarily be financial information, but could include something like legal action that we're going through right now. While that hasn't really affected our business financially yet, it could in the future. So we would have to disclose that to our users of information. Our assumptions, the first one is the going concern assumption. This basically says that our business will continue to operate beyond the period that we're currently in. Investors don't want to invest in a business that they feel will go out of business within the year. They want to make sure that it's going to be around long term. So the going concern assumption states that a business is continuing in good faith and will operate beyond a year. The monetary unit assumption means that we are recording our financial information in values that can be translated to other currencies. For instance, we have a monetary unit that is the US dollar. Other countries may have yen, pounds, the euro, pesos. Okay, so they have other monetary units that we can compare to ours. It's not like we're trying to say, well, 4 goats are worth, $2 or whatever it might be. We're just trying to say we can compare currency to currency. The time period assumption means that we can break down our business operations into equal periods. As a publicly traded company, you're required to report quarterly and yearly. So the time period for those companies would be every few months, right? So every 3 months, and then every year. Okay, so quarterly and yearly. The last one, the business entity assumption, assumes that we have each of our business operations separately. We're not recording all of our businesses as one. This would mislead investors, especially if we purchased a new business, so we absorbed it or collected a franchise, moved in with another business. It would show a very high increase potentially in revenues. That would not be accurate to report on our financial statements. So to avoid that, each business is its own entity. Okay, they're not all recorded as one.